Usually, when you get a medical diagnosis, there's this very clear expectation of precision.
Right, like a binary state.
Exactly. You break your arm, the x-ray shows that jagged white line on the bone, and the doctor just points to the screen and says, there it is, broken.
We definitely crave that level of visibility. I mean, it provides comfort when something as complex as the human body can be just neatly categorized into, functional or broken.
But the moment you step out of the clinic and into the world of corporate earnings, that diagnostic clarity completely vanishes.
It really does. The x-ray machine gets super blurry.
Right. You end up looking at this financial landscape where a company can display incredible operational health in one area and then simultaneous multi-organ failure in another.
Which brings us to today's ticker.
It does. Welcome to this Talk Tickers Deep Dive. Today, we are pointing our microscope at a company that embodies this exact paradox, and that's Beyond Air. Ticker symbol is XAIR.
Yeah, their Q4 2026 earnings report is just this fascinating collision of two completely opposing forces. It's a classic crossroads report.
And as always with Talk Tickers, our mission here is to strip away the Wall Street jargon, look really hard at the actual data, and give you an actionable, opinionated bottom line in under 5 minutes.
Because the divergence here is just stark. I mean, on the commercial side, you have this medical device company achieving massive product adoption in literally the most risk-averse environment on Earth.
The neonatal intensive care unit.
Exactly. But then on the corporate side, the balance sheet is fighting this ticking clock just to survive on the NASDAQ exchange.
So we're going to break down both of those realities, the triple-digit commercial growth, the heavy cost cuts, and how they pull life-saving medicine out of thin air.
And then we have to pivot to the severe corporate maneuvering.
Right, the reverse stock splits, the equity lines of credit that are threatening to dilute retail investors. By the end of this deep dive, you'll know if the underlying tech can actually outrun the technical pressure on the stock. So let's rip the Band-Aid off. Give me the headline numbers.
Okay, so the fiscal year 2026 revenue numbers really establish the foundation of the bull case here. Beyond Air reported $7.7 million in total revenue for the year.
Wow, okay.
Yeah, that represents a 107% increase year over year. And see if that growth is, stalling or accelerating, we isolate the fourth quarter.
Which ended March 31st, 2026.
Right. For Q4 alone, they brought in $1.9 million. That's a 66% jump for that specific quarter compared to the prior year. So we're seeing domestic and international demand just stacking up.
I mean, 107% annual increase is phenomenal, but, top line growth is often a total mirage in microcap medtech.
Oh, absolutely.
I've seen countless companies double their revenue by just tripling their marketing spend. They're effectively buying revenue at a loss. But what caught my attention wasn't just the $7.7 million in sales, it was the drop in the cash burn rate.
Because that is the metric that separates, sustainable businesses from conceptual science projects. Beyond Air improved their net loss from $46.6 million down to $33.2 million. But if you look at the net cash burn, the actual dollars leaving their bank account to keep the lights on, they slashed it by a massive 56%.
That's huge.
Down to $19.1 million this year.
Cutting cash burn by over half while doubling revenue, that is a remarkable feat of corporate engineering. And it leads directly to this pivotal line item, which is gross profit.
Right.
Last year, they posted a $1.7 million gross loss. This year, they swung to a $300,000 gross profit. Now, I know to anyone listening who manages institutional money, 300 grand sounds like a rounding error.
It's basically nothing to them.
Right. But in the life cycle of a hardware manufacturer, crossing from negative to positive gross margin is an existential milestone. It proves the fundamental unit economics actually work.
Yeah, and the CFO, Dan Moorhead, he framed this on the call around the concept of operating leverage.
Okay, translate that for us. What does operating leverage actually mean in this context?
Well, in a hardware-centric rollout, your initial capital expenditure is super front-loaded. You have to build the manufacturing infrastructure, secure the supply chain, establish the FDA quality control systems.
All the really expensive structural stuff.
Exactly. Those are fixed costs. They exist whether you sell 10 devices or 1,000 devices.
Right. So once revenue scales past a certain threshold, the cost of producing each marginal new unit drops significantly because the fixed overhead is already paid for.
Precisely. As they place more of these devices into hospital networks, the revenue from those new placements isn't being entirely eaten up by the baseline facility costs. It just drops straight to the bottom line.
Which is the tipping point where growth stops accelerating your demise and actually starts building equity. But I want to push back on this a little bit.
Sure.
I understand the theory of operating leverage, but you don't have your cash burn just by selling more units. You have to take an axe to the budget, and they really did.
They did, yeah.
Research and development expenses dropped 39%. Sales and administrative expenses dropped 27%. So my question is, are they basically starving their own future growth by slashing research and sales staff? Like, did they stop burning the furniture to keep the house warm, but now the house has no furniture?
It's the classic red flag, right?
Yeah.
Analysts see R&D cuts and instantly assume the innovation pipeline is dead.
Right, that they gave up.
But evaluating R&D spending here means you have to align it with the regulatory timeline. Beyond Air isn't a software company just constantly iterating code. They operate under the FDA's strict hardware pathways.
Okay, so let's talk about that timeline. What specifically accounts for that 39% drop in R&D?
Well, the bulk of their previous R&D budget was dedicated to the heavy lifting, engineering, prototyping, human factors testing for their next generation device, the Gen 2 system.
Ah, okay.
And they submitted that massive regulatory vehicle, the PMA supplement, to the FDA back in June of 2025.
Meaning the super expensive phase of the product development lifecycle naturally concluded. Like the homework was turned in.
Exactly. The heavy lifting is finished and it's just undergoing agency review. So maintaining that previous R&D spend would actually signal massive inefficiency.
Okay, that makes sense. It's a normalized sustaining budget now, not a gutted pipeline.
Right. And as for the SG&A cuts, the restructuring leaned out the org chart to focus strictly on commercializing the current Gen 1 system and preparing the supply chain for Gen 2. They just stripped away the exploratory overhead.
Okay, so if we accept the cuts were structural and not desperate, it brings us to the operational reality. They doubled revenue and maintained growth despite cutting sales staff by 27%. That implies the product is kind of selling itself.
It really does.
So to understand why hospitals are buying this, we need to understand the crisis it solves. The core product driving all this is the LungFit PH system.
Yeah, and PH stands for pulmonary hypertension. Specifically, they're treating persistent pulmonary hypertension of the newborn, or PPHN.
Which is terrifying.
It is one of the most terrifying scenarios in an ICU. When a baby is in the womb, their lungs are filled with fluid, right? Their blood bypasses the lungs because they get oxygen directly from the mother through the placenta.
But when they are born and take that first breath, the blood vessels in their lungs are supposed to immediately dilate, just open wide to let blood flow in, pick up oxygen, and deliver it to the body.
But in PPHN, that dilation fails. The blood vessels remain dangerously constricted.
So the heart is pumping furiously, but the blood can't easily enter the lungs. The infant is essentially suffocating on a cellular level.
Right, regardless of how much oxygen you push through a ventilator. And the gold standard treatment for this is inhaled nitric oxide.
Because nitric oxide is a potent vasodilator. It directly relaxes the smooth muscle around those blood vessels so they open up. But the way hospitals have historically gotten this gas is just archaic.
It's a logistical nightmare. For decades, the only way to deliver inhaled nitric oxide was through these massive, high-pressure, heavy industrial gas cylinders.
Right, which means the gas has to be manufactured off-site, transported in pressurized trucks.
And a hospital has to maintain a highly secure, temperature-controlled storage area for them. When an infant crashes, a therapist has to physically run, locate a 50 to 100-pound cylinder, load it onto a cart, and navigate it through hospital corridors to the bedside.
In a crowded, high-stress, critical care environment, that sounds insane.
And it doesn't end there. Because the cylinder has a finite capacity, staff have to constantly monitor the pressure gauge. If therapy lasts for days, they have to seamlessly swap out empty cylinders for full ones without interrupting the gas flow to the baby.
So this brings us to the value proposition of Beyond Air. Their LungFit PH device completely eliminates those cylinders. It acts as a localized manufacturing plant right at the bedside.
It fundamentally alters the supply chain. The machine literally pulls ambient room air into its system and uses a high-voltage electrical process to break apart the nitrogen and oxygen molecules.
It's essentially creating a contained plasma field, right? Like a microscopic lightning storm inside the box.
That is the exact mechanism. It forces those molecules to recombine into nitric oxide, and then it routes it through a proprietary smart filter to scrub out toxic byproducts, delivering pure medical gas to the ventilator.
All on demand, continuously, without a single heavy tank in the room. You never run out of gas in the middle of the night. You remove the entire procurement headache of ordering and rotating cylinders.
And the market data proves hospitals love this. They highlighted a staggering 90% customer renewal rate.
Wow, 90%.
Yeah, in the medical device sector, where switching costs are high and institutional inertia is incredibly strong, keeping 90% of your installed base is massive validation.
But retention is just one piece. User acquisition is what drives that 107% growth. And they announced a massive catalyst here. A new agreement signed on April 1st, 2026 with a top 3 GPO.
A group purchasing organization.
Right. Which, if you're outside of healthcare, a GPO is basically like a Costco membership for hospitals.
That's a great analogy.
Individual hospitals have zero leverage against massive medical device conglomerates. So thousands of them band together into a GPO to pool their buying power and negotiate bulk discounts on vetted products.
And it's a highly regulated, exclusive marketplace. Yeah. Hospitals commit to buying like 80 or 90% of their supplies exclusively through the GPO. If an emerging company like Beyond Air isn't on that contract, they are structurally locked out of the market.
The sales reps literally get turned away at the door.
Exactly. So securing this new agreement means Beyond Air is now contracted with 3 major national GPOs. They basically secured a hunting license for about 7,000 U.S. hospitals.
But having a hunting license doesn't mean you automatically catch anything.
No, it doesn't. But CEO Robert Goodman's strategy is aggressive. They aren't just going after small, isolated clinics anymore. They are explicitly targeting flagship hospital systems and integrated delivery networks, or IDNs.
Right. IDNs, these are massive regional ecosystems, a single corporate entity that owns the research hospital, the satellite community hospitals, the outpatient clinics.
And Goodman noted they are running evaluations within an IDN that controls 200 separate hospitals.
200? Wow.
Yeah, and they don't try to sell 200 units on day one. They execute targeted pilots in blocks of 10 to 22 facilities. They drop the devices into the highest acuity NICUs.
Let the clinical staff experience that speed to treatment.
Right. And once the flagship facility advocates for it, the procurement office standardizes it across the entire network, systematically ripping out the incumbent cylinder tech. Okay. They call it the spiderweb effect.
It's an incredible narrative. You've got this disruptive plasma tech, 90% retention, 7,000 hospitals unlocked, targeting massive IDNs.
It sounds perfect.
It does. But when you move to management's actual financial guidance for the future, the timeline introduces a severe contradiction. Let's look at the numbers.
Okay, so the company's shifting from a fiscal year to a calendar year, which adds some noise.
Right, let's strip the noise away. Management issued revenue guidance for calendar year 2026 of roughly $8 million, but they just achieved $7.7 million in the previous trailing 12 months. An $8 million target is like, what, 15% growth?
It's a jarring deceleration. You go from celebrating 107% growth to projecting a near plateau.
Wait, going from 107% down to 15% sounds like hitting a brick wall. Why this sudden stall?
Because of the projection for the following year. For calendar year 2027, guidance leaps to a range of $16 million to $18 million. That is over 110% growth.
So they're forecasting a severe stall for 12 months, followed immediately by a revenue explosion.
Yes, and that explosive growth in 2027 hinges entirely on one single catalyst: the FDA approval of the Gen 2 device, which is expected in the second half of 2026.
Okay, so why does the Gen 1 device have a ceiling on its market penetration?
It's the FDA labeling. Currently, Gen 1 is only approved for use within the physical confines of the hospital. It's stationary.
Oh, like a desktop computer, powerful but tethered to the wall.
Exactly. And think about a critically ill infant. They're often born in smaller community hospitals and have to be rapidly transported to a regional pediatric center via ambulance or helicopter.
So if the community hospital has the Gen 1 machine, that's great while they're in the room, but the moment the transport team arrives to put the baby in the helicopter,
they can't take the Gen 1 machine with them. It isn't ruggedized for aviation, and it isn't legally cleared by the FDA for transport.
So the transport team is forced to switch the infant back onto legacy gas cylinders for the journey.
Which breaks the continuum of care. If a massive hospital system manages a huge transport network, they look at Gen 1 and realize that only solves half their problem. They still have to maintain cylinder contracts just for their ambulances.
Ah, so that's the bottleneck. The Gen 2 device currently sitting at the FDA, that's the laptop upgrade.
Precisely. Gen 2 gets an expanded label for ground and air transport. It runs on internal batteries. It endures the vibration and altitude changes of a medevac helicopter.
And if the FDA approves this, what does it do to the TAM, the total addressable market?
Goodman stated, this transport capability quadruples their U.S. TAM. It takes it from roughly $100 million today straight to $400 million.
Because suddenly you're selling a comprehensive end-to-end ecosystem, the hospital can finally cancel their legacy cylinder contracts entirely.
And globally, this pushes their TAM past $1 billion. Management was very transparent that several massive prospective IDN customers are actively delaying their purchases right now. They want to wait for Gen 2 so they can implement a unified solution.
Hence the massive 2027 guidance jump. The dam breaks. And Gen 2 also goes 4 times longer before needing maintenance, right?
Yes. Quadrupling the maintenance interval drastically lowers the cost of goods sold. Every new machine becomes fundamentally more profitable.
So the story sounds like an absolute slam dunk. Revolutionary tech, TAM expansion, huge 2027 guidance.
It does.
But we have to pivot to the dark side of this earnings call, because the fundamental commercial success is currently being suffocated by the reality of the balance sheet.
This is where retail investors can get severely burned.
Exactly. The board approved a 1-for-20 reverse stock split to regain compliance with NASDAQ's minimum bid price requirement by July 31st, 2026. Let's ruthlessly translate this.
Yo, board.
A reverse split is like taking a pizza that you sliced into 20 tiny pieces and combining them back into one giant slice so it looks more expensive. But it's the exact same amount of pizza.
It is an emergency maneuver. If you trade below $1 for too long, NASDAQ kicks you off the exchange.
And delisting is a death sentence for a cash-burning biotech. You get relegated to the pink sheets, institutional capital bails, liquidity dries up. But even with the reverse split keeping them on the exchange, the technical pressure on the stock is devastating.
Yeah, reverse splits are a glaring admission of organic weakness. Plus, institutional algorithms often target companies post-split, anticipating toxic capital raises. Which brings us to their cash runway.
Right, let's look at the runway. Cash on hand is $17.3 million. Debt is $21.6 million.
And we praised them earlier for cutting their annual cash burn down to $19.1 million.
We did, yeah.
But when you have $17.3 million in the bank and you're burning $19.1 million a year, they possess less than 12 months of cash runway. They are cutting it incredibly close.
And that debt carries strict operational covenants. So how are they going to keep the lights on until that 2027 FDA catalyst?
Well, they highlighted that they have $18.2 million available on their equity line of credit, or ELOC.
Which is the primary engine of shareholder dilution. Let's dissect the ELOC. It's essentially an agreement with a broker acting as an ATM, right?
Right. When the company needs cash, they trigger the ELOC. They issue brand new shares to the broker at a discount. The company gets immediate cash, and the broker immediately dumps those discounted shares onto the open market to capture the spread.
So it creates this vicious downward spiral. Every time they tap the ELOC, they increase the total supply of shares, which lowers the stock price.
And the lower the price goes, the more shares they have to print to raise the exact same amount of money. If you need $2 million and the stock is $10, you print 200,000 shares. If the stock drops to $1, you have to print 2 million shares.
Which is why doing a reverse stock split in conjunction with an active ELOC is so dangerous. Management is artificially pumping the share price up just so they have a fresh, high-priced canvas to immediately begin printing new shares against.
It's a really painful bridge that retail investors are being asked to cross. Management is basically saying, we have a revolutionary product and a $400 million market expansion coming. But to survive the next 12 months, we're going to reverse split, heavily dilute you via the ELOC, and subject the ticker to extreme volatility.
The divergence is just absolute. You have a brilliant, life-saving business model wrapped inside a totally toxic financial structure. So let's synthesize this into an actionable verdict. Give me the bull case.
The bull case is rooted firmly in the tech. The LungFit PH works. It's vastly superior to cylinders. The 90% retention proves hospitals agree. If you believe the FDA will grant the Gen 2 approval in the second half of 2026, Beyond Air will effectively monopolize the cylinder-free market. That 2027 revenue explosion is a highly credible baseline.
Okay, and the bear case?
The bear case completely ignores the tech and focuses on the ticking clock. The company is starved for cash. They face a July 31st reverse split deadline. They have heavy debt, and they are actively relying on a highly dilutive ELOs to survive. The technical pressure over the next 3 to 6 months will be immense, regardless of how many hospitals buy the device.
So the actionable takeaway here is very bifurcated. If you already hold XAIR, you are functionally trapped until the FDA binary event. You have to grit your teeth through the reverse split and the dilution and just hold out for the Gen 2 approval to re-rate the company in 2027.
But if you are on the sidelines, looking at a headline that screams 107% revenue growth, do not rush in to buy today.
Right. Wait for the dust to settle on the July 31st reverse split.
Let the institutional algorithms adjust. Wait to see how much they tap that ELOC or if they execute a secondary offering. The commercial story will still be intact in September. You don't need to stand in front of a technical freight train just to capture the fundamental growth.
Exactly. The medical device might pull miracles out of thin air, but the stock market demands hard cash. It perfectly illustrates the primary rule of microcap investing. You have to ruthlessly separate the promise of the science from the reality of the balance sheet.
Absolutely.
Now, to wrap up this deep dive, I want to step back and look at the broader implications here. Because Beyond Air is literally manufacturing highly volatile medical gas out of ambient room air to replace these heavy, supply chain dependent steel cylinders.
And they're targeting massive hospital networks to completely knock out the incumbents.
Right. So if they successfully prove this model in the transport and flagship hospital markets, what other legacy medical gases are ripe for this exact same disruption?
Oh, it's the defining question for the space.
Yeah.
Hospitals rely on compressed cylinders for oxygen. Surgical suites need nitrous oxide for anesthesia. Laparoscopic surgeries use carbon dioxide.
If the core technology of generating, purifying, and delivering clinical-grade gases on demand at the point of care is now viable, are we witnessing the beginning of a mass extinction event for the legacy medical compressed gas industry?
The massive incumbent monopolies better be paying very close attention to the plasma tech coming out of these small-cap innovators.
A fascinating thought to chew on. Well, thank you all for joining us on this Talk Tickers Deep Dive. We've unpacked the explosive growth, the severe financial constraints, and hopefully made you a smarter investor in the process. Keep your eyes on the filings, dig into the mechanics of what you own, and we will see you on the next Deep Dive.